Hey everybody, it's Ian Beamer, Guaranteed Rate. Hope you're doing well. Happy New Year, happy 2022. Hope everybody's staying safe. COVID's going crazy, but hopefully it's everybody's doing what they can to look out for themselves. So, want to get into it. We've got a lot to cover. A lot of market data from 2021 is in. Also, some predictions for 2022. So. Let's go ahead and get into it. Currently looks like the Fed is pulling back on quantitative easing at a little bit faster pace than we had initially thought they might. So, quantitative easing, for those of you that are unaware, I think we've talked about this in another video or two, but quantitative easing is when the central bank, the Federal Reserve Bank, actually purchases mortgage-backed securities and U.S. Treasury bonds to artificially keep interest rates low. So they want to end that practice. They don't feel the need to keep interest rates as low anymore. Interest rates are incredibly low, record lows, and all this easy borrowing has led to, or at least contributed to, some of the inflation. So they're trying to get inflation under control. Make it a little bit harder to borrow money, a little bit more expensive to borrow money to try and combat that inflation. So they are pulling back on that. They're expected to get that wrapped up sometime around March or April. And then I believe at that time they will start increasing their interest rates. So they did come out at the end of 2021 and told us that they do expect to raise interest rates 3 times in 2022. So we would expect that first hike to be somewhere around that March or April time period when they finish the quantitative easing. So we'll see. We'll see what that does for interest rates. Generally speaking, interest rates are predicted to be up around 3, maybe 3.75, maybe even 4% by the end of the year. So far, we have seen the market pull back a little bit and interest rates come up. We're probably up 1/8 of a point, maybe even 1/4 of a point so far, just in the first 3 business days of this year, just since Monday. So we'll see what happens. Interest rates typically don't move in a straight line. So there is some ebb and flow. There is some back and forth. We'll give a little, we'll take a little back. We'll plateau. So, it's an open market and very difficult to predict. We'll just have to kind of wait and see. We do get the first economic data of 2022 this Friday. Tomorrow, we'll get the employment reports. So unemployment rates. The report at the end of 2021 in December for November of 2021 was unemployment was 4.2%, which is really low, very healthy, very strong in and of itself. But while unemployment is 4.2%, the participation rate is also very, very low. So the participation rate, if any of you have been paying attention, the service industry, for example, anybody that runs a restaurant, travel industry, a lot of us were watching the news is a lot of flights were canceled over the holidays because they just couldn't find pilots. They couldn't find the air crews to service those flights and get people where they needed to go. So we'll see what happens there. A lot of reasons for that. I've listed them in the email. We'll see what happens. Home ownership for 2021. Some data for home sales in 2021. The average homeowner, the average seller in 2021 owned the home just 8 years. So that's down on average 2 years from the average seller in 2020, which is pretty big news. So from 2008 through 2020, the average seller owned a home about 9.2 years. Prior to 2008, going back to all the way from 1985 through 2008, the average homeowner was owning the home, holding onto their property just 6 years. So 6 years for on average for 30 plus years. And then obviously in 2008, for those of us that don't remember or perhaps weren't paying attention for 3 or 4 years, we had a little bit of a hiccup in the market. So prices fell drastically for years, from 2008, probably 2011, 2012. So a lot of foreclosures. The bubble had burst. So I would guess that has to play a role in why homeowners were holding on to properties a little bit longer. So if you lose your equity, your house might be underwater. You're not going to be able to sell. If you owe more on the home than the home is valued, then you can sell it for. Nobody wants to bring money to a closing on a sale. The idea is to profit. So that obviously led to people holding on to the properties a little bit longer, or at least I would think. So you make your own decision, but I thought that chart was pretty interesting to look at. Some other interesting stats from 2021. First-time homebuyers made up 34% of the market. So 34% of all purchases in 2021 were first-time homebuyers, which is great to see. Great to see first-time homebuyers get in the market. That was up from 31% in 2020. So it's great to see that. Average purchase price, which should not shock anybody. Anybody who's been in the real estate market or turned on the television in 2021 saw the reports on home sales. Every seller was listing a property, and in days you'd have multiple offers. So the average home sales price was 100% of the asking price in 2021. So it makes sense. It makes sense if you think about it. The last key piece of information that I saw from the report from 2021, the average age of a repeat buyer in 2021 was 56 years old. 56 years old, which is a record high for the average age of a repeat buyer. This means seniors, retirees are purchasing. They're purchasing homes. They're moving to wherever they need to be for their retirements and maybe someplace warmer, and they're purchasing. They're not renting. They're not holding on to their homes for 40 years. They're going to where they want to be, and they see the value in home ownership. So as do the first-time buyers. So I thought both pieces of information were key. It's a very strong housing market. Great to see. So hopefully you found this video, this email informative and helpful. Again, everybody stay healthy. Everybody enjoy their 2022. Make it a great year. Thanks for tuning in. I'm Ian Beamer with Guaranteed Rate. Thanks for watching. Take care. Bye-bye.